10-year note Treasury yields end the week nudging ever so slightly higher, failing though to get above that 140 level. Recall we've been in this 120 to 140 range for about the past 6 weeks. So we got as high as 138 today before backing off just ahead of the close. Again, we've been up this road about 2 or 3 times over the last month and a half and cannot push through. Obviously, the data isn't enough. Some of the Fed speak isn't enough. Maybe it'll take an FOMC meeting if we're to see north of 140, and we're going to get that next week, and we're going to talk about that shortly. But again, the market seeing a lot of back and forth, spending most of the week right around the midpoint of that range, but again, extending higher as we head in ahead of the weekend, nearing that 140, but unable to press through it. Now, what does this mean for volatility? Well, if you check out that CVOL index over at cmegroup.com, you will notice that volatility remains directional with yields. So as we see yields go higher, bond volatility goes higher with it. Likewise, in the reverse, we see yields go lower. We see bond volatility go down. Now, some of this may be happening, the directional movement with volatility and yields, but also we have that event risk that pops up from time to time. We saw it last week ahead of some of the inflation numbers, and likewise, we'll see it ahead of the Fed meeting next week, and it's already started to move that way. So the event risk will tend to bid volatility as well as the directionality of the underlying. So volatility higher heading into the weekend ahead of next week's FOMC meeting. And let's talk about that FOMC meeting. What are we expecting from the Fed? What can they do? Well, at this point, going back to the Jackson Hole Symposium at the end of August, we anticipated that the Federal Reserve would talk about tapering, how they might do it, when they might do it, but they didn't do that. Fed Chair Powell obviously took a different road at that meeting, talked a little bit more about concerns and being patient. Now we come up to the September FOMC meeting, which was supposed to be a meeting where they might actually taper, but obviously that's not on the table. So now the Fed looks to possibly talk about tapering again, maybe announcing some kind of a formal tapering later in November or December, possibly even as late as first quarter of 2022. At this point, the market is on pins and needles. It wants some clarity. It's certainly gotten one side from the Fed chair and from other presidents and governors. It's gotten another who want to be a bit more hawkish. So it will culminate at this meeting on Wednesday. We'll get to hear from the Fed chair himself after the meeting. And one of the things about these types of meetings where you may have a lot of discussion and debate, we won't hear about that on Wednesday. We'll hear what the Fed chair tells us. But the minutes, which will come out 3 weeks later, will give us a more in-depth look at the meeting. Those might actually be more interesting than the meeting itself. It all depends on what comes from the Fed chair's testimony after the FOMC meeting. Will they taper? Will they not taper? Will they talk about tapering? Will they say nothing? And those are all things that could happen. Clearly, the market's anticipating that there will be some kind of taper talk. We've seen positioning that in treasuries for yields to go higher. It'll be interesting to see if the Fed actually follows through on that because, again, it didn't happen at the August Jackson Hole Symposium. So the market now moving its chips that it will happen at next week's September FOMC meeting. So the 10-year note yields holding that 6-week range, that 120 to 140 range, but now nudging ever so closer to the top of that range ahead of the biggest event we'll see probably this month, September FOMC.